Good everyone, let's hear from BG Trading. Hope you are well. Today is May 12, 2023, and I'm going to be analyzing BHP, Rio, and Fortescue, which are the ASX leading iron ore stocks. The reason I'm doing this analysis today is simply because finally those stocks, those three companies are now trading on what we call technically fair price. All of them have been trading at the former levels for quite some time, and that's exactly where we don't want to be buying those stocks. But now they are reaching a very attractive levels. Although I still wanted to put them on my watch list and wait for further price degradation in order to take even better advantage of potential cheaper prices on those stocks, I think it's very important now to note that those stocks are finally back into what we call buying area, according to our strategy. So let's have a look. I just want to remind you this isn't financial advice. It's just as from BG Trading, sharing with you how we apply our strategies to reach 20 to 40% within 1 to 3 months lead time, how we set up targets, stop losses, how we avoid FOMO, and much more. So all in this channel. So if you like, please subscribe, share this video with someone that you believe would be interested in looking at. And also, I wanted to invite you to become a member of our free Facebook community. We call it Buy, Grow, and Sell Strategy for Share Traders. This community, we post a lot of great quality content, so much stock analysis, fantastic conversation with our members about potential buying opportunities, and obviously some of our results. Now let's jump straight into the reason I am looking to not buy yet, but looking at those three stocks now. First of all, we always try to add value to our viewers here in this channel. It's very easy, and I keep repeating myself, very easy to come here and do an analysis about a stock that has rallied 30, 40, 100, or even 200% after it's rallied. But that is a big trap because I'm not really add value. But now that we have some leading companies trading what we call technically fair price, there could be potential some buying opportunities for mid to long term right here. Although again, I'm going to enforce this. I'll be waiting for those stocks to come off further, and I think they will. I'm going to show you in the chart formation in a few minutes. Now, iron ore is trading just above $100. Some analysts now saying this is not a sustainable level, but the reason I want to stick with those three major companies is that they're able to produce iron ore at around $20, and that's a big competitive advantage among some smaller producer that has a much higher production cost. Now, although a lot of so-called analysts has been tipping to buy iron ore stocks over the last few months, and you've seen some decline, consistent declines across the board, I wanted to share my reasons that I have been skeptical over the last 4 or 5 months to buy iron ore, simply because we have to understand where we are into the economic cycle, and I have brought that back in the last few videos about economic cycles and even pinpoint why we avoiding iron ore stocks. But I want just to remind you, now we are into what we call contraction phase. Okay, contraction phase means the economics is slowing as a result of a massive monetary tightening. And when interest rates is going up, it's good for material stocks like iron ore. So it's great because infrastructure is booming, building is booming. But then when after the interest rates are up, and that's what we are pricing now, then it's likely that we will see some cut on interest rates maybe in 2024 or later 2022. We don't know. We don't want to speculate on that. But that brings us back to where we are at the macroeconomic cycle, and that's exactly the point. In contraction phase, which is exactly where we are, material stocks tend to underperform the market, and we don't want to be exposed to material stocks, although we are making a hell of our week out of lithium stocks. Base materials like iron ore tend to underperform. And let's take a look now with the chart formation. Starting with BHP. Now, you see, the pink line here highlights what we call as the long-term moving average. And as you can see here, BHP has just now started touching the long-term moving average, which puts the stock on what we call technically fair price. So that's the only level that we want to be buying. We don't want to be buying the stocks when are trading above that level, because you're going to be exposed to a higher risk, although earnings could go up. But still, economy is a cycle, commodity is a cycle, and it's not going to go up forever, and earnings will come down. And I've been warning in this channel that earnings on those material stocks are supposed to start contracting as a result of this hike of interest rates and monetary policy. And then exactly what's happening. So yields are start coming down. And as a result, the stocks coming down as well. In fact, if you have bought BHP back in 2007, just before the GFC, you would see that BHP reached levels of $50. And it is, think about it this way, it's currently trading at $43, which well below its quotation back 15 years ago, which again brings to the reason why we only trade in the market and we don't invest on stocks. We trade stocks. For us, investment is all about real estate, not stocks. But we do use our strategies to trade those stocks, make some good cash, and invest that spare cash into real estate. I'm just proved to you that why you always got to be careful. And essentially, we need to buy those stocks when they are trading under the long-term moving average, which is not yet the case, but we almost getting there. In fact, I will be very interested to look at buying BHP, to be honest, because it's possible. Although our strategy normally aims for small and mid-sized caps, which is not the case of a BHP, it's possible to make 20% if you buy under the SMA upon the following rally, and also buying on those levels is secure a higher yield on that type of stocks if you're looking at for dividends in the mid, like short to mid sort of term, and also give you a long term opportunity to lock in profit. But as you can see here, if the share price comes down to between 36 to 39 cents, let's say around $37, a potential 30% rally, it's on the cards, and that's what we'll be chasing for BHP. Not yet, so I think still heading towards this year as the candles start putting pressure towards the 250 moving average, it's likely that we'll see a breakout. That's what we're waiting at the moment. That's why we also have a short position in the market, smaller than we had a couple of weeks ago, but because we had to take this money, some of these funds and put into lithium to take advantage of the lithium rally. But still, we believe this will put further pressure on the index, on the S&P ASX 200, and then perhaps we will see the whole market falling as a result of that. Okay, so this is BHP. My buying area, guys, if you ask me, gets a little bit slow with this. Yes, this would have been under $40. This would have been my ideal buying levels for BHP. So patience is key to success. So I'll have patience and wait that to happen if we can take advantage of that. But sometimes, obviously, we don't try. We don't hope for bad things to happen, because a lot of people invest in those stocks. But I can see that potential formation, potential reach some stage this year. Just keep that in mind. I want to buy BHP around between $36 to $39, and I think that's going to happen some stage this year. So now let's move to Rio. Rio is the second largest iron ore producer. Also, as you can see, pretty much the same formation. Finally, out of the FOMO area into technically fair price as well. Now, where would we be buying Rio? Around $90. This is the level where I'm looking to buy Rio. Okay, so I don't want to be buying now. It's too high. We're in contraction phase, and the chart formation suggests that we see some further leg down. But I would chase $90 here. That is my target. Sorry to disappoint those that think the market is bullish. Now, moving towards the third stock, Fortescue. This is the best trading stock of those three. See, if we able to buy a Fortescue again around $16, you see that was a rally of 40, like pretty much 50%. Now, I would still chasing 20 to 30%, but I would be looking buying a Fortescue FMG around 15, around 15 to 6, between 15 to $16 a share. Also expecting that to happen. Hopefully it doesn't happen. We can trade all the stocks as well, but if it happens, that's where I'm going to be buying there. And that is a pretty strategic position for midterm as well, mid to long term, provided that earnings of those companies should keep growing, okay? It's all to do with the time in the economic cycle, not about what I think, and the chart formation. Yeah, so that's Fortescue. Now, let's go to smaller producers, okay? But the problem with smaller producers, and they tend to fall a lot harder as a result of higher cost of production. So I'm going to also add GRANGE Resources here, which is another iron ore producer. And unfortunately, as I said, those stocks tend to fall a lot harder. But once you are sort of into what we call buying area, and you able to take the rally, then as you can see here, where a BHP was offering 40%, Fortescue 50%, this stock would have rally about 81%, giving or taking. So a lot larger swings, like wider swings, but at the moment it looks like it's going to fall through here. So I'll not chasing this stock until we see some reversal into the leading stocks, and then even profit out of some leading stocks and then go to those stocks as second instance, because the leading stocks tend to move first and then those smaller stocks tend to move after. So GIBSON is another one, also taking a massive hit. So taking a massive hit. Again, giving the same example, we have about 38% fall, but if we have bought that where around these sort of levels, there was a rally of 80%. So GIBSON and GRANGE Resources pretty much giving sort of similar results, but they tend to move after the leading stocks. And obviously, I don't have to say that this is a lot more riskier in order to invest, sort of speaking. So I wouldn't invest on those stocks. I would just definitely trade. And if I ever would be looking at investing into iron ore companies, I would definitely stick with the leaders for that. But you know that we're not keen investing on the stock market for long term. Anyway, so this brings us to the end of the video. Hope you enjoy that. Let us know what you think about iron ore stocks. So you think gonna fall more, gonna rally from now? What do you think? Will be lovely to see all your comments, and I will be answering each one of them. Thank you very much. See you in the next video. The whole idea when we designed BG Trading BGS 20 strategy was to use only a set number of indicators to make it simple and clear to understand and to be able to apply our KPIs very easily and very effectively. So you don't have to be any Wall Street smart person to be able to apply those strategies. We really hope this course will help you to make better decisions and make successful trades. See you in the course.